Welcome everybody to my channel. I'm the commerce specialist. A very short and brief introduction of mine because that's necessary. Students and viewers will think, why should we listen to this person? What academic authority or command on the subject he has? So that's why I'm just giving you a brief introduction of myself. Well, it has been about 24 years I'm in the profession. I've worked both in the corporate sector and in academics, on and off. In the corporate sector, like to name a few companies, it's like Deutsche Bank, American Express Bank, Standard Chartered, Cable and Wireless, numerous public limited companies. I've been into positions right from an assistant to internal auditor, right up to general manager corporate finance, and in academic, starting from the scratch, teaching in schools, colleges, universities, and professional institutions. So if we talk about my education, well, I have a bachelor's in accounting. I have also done my MBA in finance. I've got a teaching degree as well, that is bachelor's in education, along with 3 professional accounting certifications, one from Pakistan, one from UK, one from USA. So that's all about me. So this channel will be all about content relating to accounting, finance, auditing, management, business, so on and so forth. The students especially, because there's a lot I have to discuss in the upcoming videos. So because this is the first one, I just need to tell you that this content is very, I would say, appropriate and useful for students who are doing their A-levels, O-levels, BCom, bachelor's, master's, including especially students who are doing their chartered accountancy, which is CA, ACCA, CMA, and CPA. So the topic which I'm going to cover today relates to all these qualifications I just mentioned you. So I'm going to start from the basic. So cutting all this discussion very short, coming to the topic directly. The topic I'm going to discuss today is depreciation. Now, what is depreciation? This is the first question. Because before we go ahead with the technicalities, the procedures, the calculations, one need to understand, number one, what is depreciation, why it is important, why do we calculate it, how do we calculate it, so on and so forth.
So guys, let me give you a very simple example of what is depreciation. Assuming you purchased a cell phone for $400. If you purchase a cell phone for $400, after using it, let's say for 2 years, if you try to sell it, will you be able to sell it for $400? Answer is obviously no. Because the phone has become old, you have used it, probably newer versions, newer technologies have come in the market. So what is happening? The phone which you purchased for $400, assuming after 2 years when you sell it, you are getting only $100. So this fall in the value from $400 to $100, the difference is known as depreciation in layman's word. The simple meaning of depreciation is fall in the value of non-current assets. Non-current assets are obviously assets which we use for more than 1 year. Cell phone is one of them. So if you're buying a cell phone for $400, you're using it for, let's say, 2-3 years. After that, if you're selling the phone, you're getting only $100. So the amount which you're not getting from 4 to 100, the difference 300 is your depreciation. Now, you may ask why? There are many reasons. Number one, there is some wear and tear on the phone. The phone is used. The phone has become now old. Obviously, cell phones are, they come into electronics. Electronics have a very high rate of depreciation. Why? Because as a new technology comes in, the older ones become close to obsolete. People would obviously like to buy new technology at the prevailing market price rather than buying an old technology. So in this example which I told you, buying a cell phone for $400, selling it after a few years for $100, $300 is your depreciation. Now the next important question to ask is, why depreciation? Why do we calculate depreciation? Why is it important? Well, depreciation is taken as an expense. Just as you pay salaries, you pay rent, you pay insurance, repair and maintenance, depreciation is also one of your operating expense. Which means you will not be able to calculate correct profit if you do not take into account all the expenses of the year, which includes depreciation as well. Now next we need to know, okay, we understand what is depreciation. It is the fall in the value of non-current assets. If you want, I can give you a definition which is there in most of the textbooks. It says it's a systematic allocation of cost of assets over its useful life. In other words, like say the phone which you have purchased for $400, assuming you use the phone for 4 years, and further assuming after 4 years you are unable to sell the phone to anybody. I mean, there is no market price for it, there is no salvage value, there is no scrap value for it. So what does this mean? This phone which you purchased for $400, you use it for 4 years. If you divide what you're getting 100. Now this is actually your depreciation per year. Obviously you're using it for 4 years, year 1, year 2, year 3, year 4. Every year your phone is depreciating by $100. Depreciating means the value is falling. Why? Because you're using it. So at the end of the 4 year, what is the total depreciation? $400. We use, in a layman's word, we can call it total depreciation. But technically in accounting, we call it either accumulated depreciation, provision for depreciation, or allowance for depreciation. Meaning total depreciation. So if the phone which you purchased for 400,000, you use it for 4 years, every year if it is depreciating by $100, so at the end of 4 years, what is the total depreciation? 400. And you may call it technically as accumulated depreciation, provision or allowance for depreciation. So I hope you understand what is depreciation. I also told you why it is calculated. It is calculated because this $100 is taken as an expense. Among your numerous expenses, you also take depreciation expense for the year. Like you're talking about salary for the year, rent for the year, insurance for the year, you also consider depreciation expense for the year. Only then you will have all your expenses. Now, people will think, why do we need to consider all the expenses? So ladies and gentlemen, please look at this. Matching principle. The whole, the name of the whole concept is matching cost with revenue. As and when relevant and appropriate, I'll be discussing in my, upcoming lectures as well, the different accounting concepts and principles. You cannot have command over accounting if you don't know the accounting concepts and principles. Matching principle is one of them. Actually, there are around approximately 14 accounting concepts and principles. Certain books, they call it GAAP, Generally Accepted Accounting Principles. Some books will call it accounting principles and conventions, or simply accounting concepts. It's just like, everybody knows how to drive a car, but everybody doesn't know all the rules. So in my experience, last 24 years, I've come across different teachers, different students, but unfortunately, with due respect to most of them, some of them knew accounting but never knew all the concepts and principles. Actually, the concepts and principles are the whys behind the questions. So what we're talking now, coming back to the topic, is why all expenses are to be considered. We have a matching principle. Matching principle says in order to calculate profit or loss of a particular period, we have to match, we have to compare, we have to take into account all the revenues and income of that period and all the expenses of that period. Which means if we are talking about, let's say, calculating profit or loss for year 2019, I have to make sure that in my calculation, I have considered all the revenues, incomes of 2019 and all the costs and expenses of 2019. Only then I'll be able to calculate the correct profit or loss. That's one of the reasons we have to calculate depreciation, so that we do not miss any relevant expense of the year. I hope you guys understand now what is depreciation, why do we calculate depreciation, and the ifs and buts behind it, why. The main concept here is matching principle. We cannot ignore any expense. Depreciation is one of the expense. Now, ahead, what's coming? Now, next what we're going to discuss is how depreciation is calculated using different methods. In fact, in this video, I'll be only discussing two most common methods of depreciation, which everybody needs to know. In the next video, I'll be talking about depreciation as per IAS 16, International Accounting Standard 16. So there we'll talk about, all the nitty-gritties with special focus on revaluation. So guys, now let's talk about the two main depreciation methods, the most common ones in fact. The very first is known as straight line depreciation method. I'm just writing it here for you. Straight line method. Now I'm going to give you a very small and simple numerical example to show how depreciation is calculated using straight line method. So all we need to know is number one, date of purchase. Let's say January 1st, 2015. The cost of the asset, we are talking about, let's say, 100,000. Salvage value, let's say 20,000, and life in years, let's say 4 years. So this is the basic information we need to calculate depreciation. So we are assuming here like the accounting year ends on December 31st. The accounting year ends on December 31st. Now, what to do? We have the date of purchase when we are buying the asset. We have the cost of the asset. This salvage value simply means if you use the machine which you're buying for 100,000, if you use it for 4 years, after 4 years, if you go to sell it, how much approximately it may sell for? That is salvage value. So when we're talking about straight line method, the very first thing to do is you have to start off with the formula. The formula is like this: annual depreciation is equal to cost minus salvage value divided by useful life. So if I just plug in the amounts here, cost is 100,000, salvage value is 20,000, and the useful life in year happens to be 4 years here. So when you solve this, 100 minus 20 is 80,000. 80 divided by 4 is how much? 20,000 every year, and this is your annual depreciation. This is straight line. Now if you want, you can calculate straight line depreciation for as many years you want. Basically here it's 4 years. So if for 1 year it is 20,000, for 4 years it's going to be how much? 20 into 4 is 80,000. This 80,000 is actually your total depreciation over 4 years. Okay? So now if you look at, it fits properly here, you're buying a machine for 100,000. You're using it for 4 years. In 4 years, the total depreciation happens to be 80,000. This is your total depreciation. So after 4 years, if when you sell, how much do you get? You get 20,000, which is your scrap value. Is this understood? Great. Coming to the next, I would say, the next most famous methods of depreciation, which is declining balance. We call it declining balance method. Actually, this method has numerous names. You can call it declining balance method, you can call it reducing balance method, you can call it diminishing balance method, you can call it written down balance method, net book value method, but the method remains the same, the working remains the same. So here I am assuming details as before. Let's say again, if I write date of purchase to be the same, January 1st, 2015, cost of asset, let it be, let's say, same 100,000. Okay. Life is given as 4 years. Let's change a little, 5 years. For a change, no salvage value. Okay. And in this method, most of the time, a percentage is given. A percentage, let's say 20%. And you are asked, given this data, you are asked to calculate depreciation using declining balance method at the rate of 20%. How to go about it? So please understand, in straight line, we used to have, we start with a formula first. In declining balance method, there is no formula. You can straight away come to the calculation. I would suggest, this is just recommended, it's not mandatory, that you make a table like this. Let's say this is date. This is computation. This is your depreciation expense. This is accumulated depreciation, means total depreciation. And this is book value. Book value means value after depreciation. So we are assuming, let's say on January 1st, 2015, how much did you purchase the machine for? 100,000. So you write here 100,000. Please understand, on the date of purchase, the cost and the book value is the same because you have just purchased it. Now there is no depreciation on it. Understanding our assumption is, when is the year ending? December 31st. So from January 1st to December 31st, from January to December is 1 year. 1 year depreciation is calculated like this. Look at the rate. 20%. Please understand, 20% means 20 upon 100. Multiply by what? Multiply by this amount, which is the cost. So when you do this, obviously you get 20,000. 20,000 is your depreciation for this particular year, which is 2015. Now what you're going to do is accumulated depreciation. Please remember, in the first year, your depreciation expense is the same as accumulated. Accumulated means total. So total is how much? Just 20, because this is the first year. And now what you do, from this 100,000 you minus 20, you will get the book value. Book value means value after depreciation. You purchase the machine for 100,000, you use it for a year, the total depreciation is 20. How much is the value left after depreciation? 80,000. Coming to year 2, which would be December 31st, 2016. Please remember, the rate, the percentage remains the same. 20% as given in the question. 20% means 20 upon 100. But what you're going to do now, you're going to calculate 20% on this declined values. Look, the value is coming down. From 100 it become 80. Now you're going to calculate on 80,000. So 20% of 80,000 would be 16,000. Now 16,000 is the depreciation for the current year, which is 2016. Now what you're going to do is, preferably you add these two. 20 plus 16 gives you 36. 36 is the total depreciation, which we call accumulated depreciation, provision for depreciation, allowance for depreciation. And then what you do, always subtract it from the figure on top here. 100 minus 36 will give you 64,000. This is the book value. When you move on to the next year, 2017, rate remains the same, 20 upon 100, which is 20%. Of what? 64,000. So when you take out 20% of 64,000, you will get 12,800. When you add 36 and 12, it will give you 48,000. 48,800. From 100,000, when you minus 48,800, you will get your book value, whatever. You can calculate that. So 100,000 minus this will be, I guess, 51,200, if I'm not mistaken. We can calculate that. 100,000 minus 48,800 is 51,200. That's correct. Finally, we are moving to 2018. Rate remains the same, 20 upon 100. Multiply by this 51,200. So 20% of this would be 10,240. Then you add these two, minus from this, you will get the book value and the accumulated depreciation. So, guys, what you need to focus on, when you're talking about straight line, as the name says it all, straight line means every year your annual depreciation, can you look at this? Annual depreciation every year is 20,000. The same amount of depreciation every year. But when you talk about declining balance method, declining means going down. If you look at the depreciation, in the first year it's 20. Then it's going down. Second year depreciation is how much? 16. The third year depreciation is 12,800. And then finally 10,240. Look how it is falling from 20 to 16, 16 to 12, 12 to this. And if you look at this percentage, 20% is calculated on cost. See, the balance is going down. Then it is calculated on the book value, then the fresh book value, then the new book value. That's why we call it declining balance method. The rate is calculated on a declined balance every year. So is the depreciation. Now, after having discussed all this, $1 million question. If you are in an organization, if you are responsible for accounting and you have, as a manager, you have been asked to, choose a method, would you choose straight line or declining balance method to obviously calculate depreciation on your non-current assets? So the question here is actually which method to choose. If you are given an option, would you like to calculate depreciation using straight line or declining balance? So it's not that we are going to toss and see if a head comes, we'll talk about straight line, if tail, it is declining balance. No, it's not like that. Basically, depreciation is one of the major, contributing factor to depreciation is the use. Why non-current assets lose their value? Why do assets depreciate? Because they are used. This is one of the reasons. So in order to choose a depreciation method, whether it be straight line or declining balance, you need to know the usage pattern of your asset. How you're going to use it. For example, I've purchased a car. I'm just giving an example. I've purchased a car and this car will be used only for me, traveling from my house to the office and office to back home. That's it. Which means, let's say if the distance is 100 kilometers in a month to and fro from house to office and office to back. So in a year it will be 1200 kilometers. So neither I am shifting my house nor my office is relocated, which means every year I am going to use the car for 1200 kilometers. What I'm trying to tell you is my usage is constant. I'm using my car 1200 kilometers every year. So if the usage is constant, so is the depreciation, 20,000 every year. But what if I'm going to use the car initially for marketing purposes? Later on, you understand marketing, like, the initial years, you really have to work hard, running from pillar to post, circulating your brochures, documents, leaflets, information, content. And once everybody has it, then you can relax a bit. Or in another example would be like, in a factory, if you're buying a new machine, first you create a stock. You don't want your warehouses to be empty. So maybe in the first 2-3 years, your production will be more as compared to successive years, the preceding year, the next year. So if we talk about a factory manufacturing XYZ items, the first 2-3 years, their production is going to be a bit higher. Later on, when they'll get to know what is the market demand for their products, and then later on they realize that we don't need to manufacture so high, we are going to manufacture less depending on the market, the demand. So if you look at depreciation here, the first year depreciation, the initial years it's high. And in the years to come, it's going down. So if you plan to use your asset constantly over the years, the recommended method is straight line method. If your usage of the asset is more in the initial years, less in the successive years, declining balance method is to be used. So guys, my next lecture we'll be talking about IAS 16, how it relates to depreciation. Basically, if you talk about International Accounting Standard IAS 16, it has all the guidance relating to depreciation. And by now you guys should know, like, what are IAS. These are International Accounting Standards, now converted to IFRS. Every standard has some guidelines. For example, IAS 1 is all about preparing financial statements. IAS 2 is about inventories. Soon I'll put up a video on inventory as well. IAS 16 is all about depreciation. What is depreciation, how to calculate, why to calculate, what are the methods, the do's and don'ts. So next lecture would be on IAS 16 with special focus on revaluation. Thank you very much, everybody. I hope you have this video has been of some value to you. So if you like this video, please subscribe to my channel. Please press the like button, the bell icon, and the most important thing is I want you guys to please leave a comment. Your comment will make me understand whether you like it or not, what type of content you need. You can put your demands there. For example, if you need the next video on IAS 16, or it could be on receivables, cash flow IAS 7, earning per share IAS 33, or simple basic accounting, terms, concepts, rules of debit and credit, suspense accounts, any accounting and finance topic. So if you leave it in your comment, looking at the comments about the demands, what most of you all want, my next video would be on that topic. Thank you very much for giving me your precious time.